Good day, everybody. Welcome to another Will My Trading Basket Beat Your Trading Basket. Okay, so just so you know, we're doing our live webinar on that topic, not tonight, on February 15th at 7 p.m. due to Valentine's Day. Alright, so you can see here, this is today, February 14th, at 1, basically 10 to 2 Eastern Standard Time p.m. You can see here we got a lot of downward pressure in the U.S. indices. They're all down. Crude oil is up quite a bit. Gold is up. The mix on the Euro USD down. Bonds are up. Pound is up. Sorry, pound US dollar's down. US dollar, Japanese yen's barely up. Bitcoin's up barely. The CCAC cryptos up quite a bit, and then the foreign markets of the FTSE and the Nikkei for Japan, UK are down from last night. So there clearly is a lot of downward pressure. So when you look at the mix of what I've tried since last Friday, basically these two, this combination did quite well. If you've not seen my video, you take out silver out of these four. The difference with silver and taking it out, the difference is about via 20%. Now, this one has a few things we need to talk about. Is over corn and USD Swedish. So originally I had gold in there, wheat. There's no equity whatsoever. Even gold was taken out. But the performance has been pretty good just with gold and US dollar and Swedish krona. The result is basically this. Right now, what you need to pay attention to is if you were to look at my event that I just stated on the webinar coming up for tomorrow night, and if you go to quant-labs.net and I click on the events, hopefully it'll just show up right here. Okay, in there I posted the return of the U.S. equity global market over the last since the beginning of this year, 2022. Look at how bad it is. 5-day is negative 1.8, 1 month is negative 5.2, 3 month is negative 5.6, and year to date, since the beginning of the year, is negative 7.3. So there's clearly downward pressure. If you want to know where I got that, just visit here at marketwatch.com. Okay, so the US and worldwide global markets are negative. They keep talking about inflation is because of this shortage in worldwide product. That is a bunch of BS. Okay, it is national debt. Okay, they don't talk about it, and when I say that specifically on Bloomberg, and it is the national debt that's the problem. So inflation is not going anywhere. So I've talked about how to get around this. So late last week, a few days ago, I talked about on this new domain, quant-labs.net, the video you can see here, tracking silver, gold price makes huge difference in returns for a portfolio. So now, there's a couple of things we can use as metrics to see how they're doing. First, one I use, very important, is gold-silver ratio. This is so accurate. You can see it's been very flat, so there's really no up or down. But here, when you look at the daily, you start to see it. It's very volatile since September 21st. So it has risen a bit over the last year. Which is not a good sign because that means it's overall global risk everywhere globally. Now, people can say whatever they want. The charts don't lie, the math don't lie, and this is what you get on a 1 month chart. So when I say the gold-silver ratio is your number one reliable indicator, you look at back to 2008, 2009, we have the financial crisis. It rose quite a bit, came back down as everything where the Fed, global central banks started to pump money into the economy, starting here January 11th. So we had pretty close to a decade of easy money, and then it spiked as well. And when it spikes, so here is the good times when this gold-silver ratio drops. Means there's less risk in the market. But as they pump more money into the global market, courtesy of the Federal Reserve, other central banks, you can see here that the global risk has risen. So it's gotten to a point where we're now at the peak of 2008 and 9, and it's still continued to rise past 2017, let's say, and then the virus kicked in, the global sickness, and boom, it spiked. Then it drops back because more is added, and look at it starting to reverse and starting to climb back again. So what I'm saying is that we have normal conditions here of when things spike, and this is pretty well dead on, gold-silver ratio. So as risk starts to build back into the global market and global economies, something's got to give, because there's been nothing out there, and as more central banks pump money, it does temporarily drop back for, in this case, 2 years in 09 to 2011, but you cannot deny the fact that there's inflation building up here and just overall global risk. So let's look at what this thing has chosen today, showing you what I've shown you in the markets just today. So we've gone from this set of portfolio, this basket here, with gold and silver, and from what I'm seeing, gold may drop back, okay, because it's starting to show shorts as of today's data, okay. Now, how can we verify that? Well, there's a couple of ways. Doesn't matter what gold in currency, whatever you want. Let's just keep it nice and easy. Let's keep it XAU in USD, okay? So this is cheap data, well, free data really from Oanda, but this is accurate, okay? When you look at the gold price has been performing quite nicely here, gold in US dollar. So right here, $1,000 starting September, August 2018, peaked here at $2,000, and right now it's gone flat since then. So the gold price, the gold spikes you're seeing are very temporary. So if I whittle it down to, let's say, an hourly basis, you can see here it is rising, it is moving up, but it's slow and steady. Doesn't mean, so that's an hourly basis. Let's look at the 15-minute. Been fairly flat, so it could drop back, may not, but generally what I'm finding is how I'm doing it is pretty accurate. So what has been chosen is gold and, in this case, USD and Swedish krona. Corn's been doing really well. Let me just see here. Corn is outperforming gold leaps and bounds here just in the last few months, as you can see, comparative to gold, again in US dollar. I don't know why people want to put money into that. I mean, there's nothing wrong with it, but you can see it's been very flat. Compare that to, once again, corn. Who would think, right? But look at it, it's been a nice spike for the last 3-4 months. So you got some performance there with corn. Now, when you break it down to an hourly basis, nicer trend up. I mean, it's a lot more volatile, but here's your big bar right there. This is a 1 hour chart actually, and even on a 15-minute chart, big bar moves. Corn's been fairly consistent, and the last one we can look at is anything in Swedish krona as a currency. So again, let's just take a look at the euro one. Boom, just a nice steady spike. Okay, so that's what we have. We have two at 50% allocation each. This is what it generates. Now remember, I showed you here that the U.S. and global equity markets are negative. Okay, so they're negative year to date, down 7.3%. So when you look at what this thing generates right here, the report, this one right here, this one in blue is the gold and euro, USD and Swedish krona, as well as corn. So you can see here it's been spiking much better than the benchmark, which is the standard S&P 500. So here just in the last year, since last year, let's say February, March last year, your total return would have been 11.99%. But even if you just had those two assets that I just mentioned, you'd be up 45%. So you're over 3-4 times more than the S&P 500. So here's a couple of things you take away: is volatility still outperforming with that basket, and here's the performance for last year. The strategy is much higher, okay, than the 20% you would have got with the S&P. But look at this is the more important one, is the last 2-3 months. The strategy of the corn and USD and Swedish krona, it's positive. It's over 10% return for just 2022 so far. Meanwhile, the S&P 500 has been negative. So again, this is your money. This is how you plan. This is how you retire. If you're not getting this, if your financial advisor's not getting this, then you need to revisit and reassess everything, because the easy money is done. Okay, I've shown that just earlier. Also, what's important here is you want uncorrelated assets that have nothing to do with each other, and that's how you'll get the better performance. Okay, so right here you see it. So these stats are really important. Look at this chart; it's almost to 2. Okay, so again, these charts don't lie. But what's also important is the monthly returns you would get with this strategy. 8.1% last month in January, and so far in February, 2.45. So I'm constantly rebalancing and looking at these baskets, and I've talked about the risk management as well. What I'm doing in the next few days is announcing this subscription service to help you assess this, to get the better returns, optimal returns that you'll get, better than your portfolio manager, better than the financial advisor you're probably paying thousands of dollars a year for, or percent-wise or whatnot. They're not going to give you what you want. And even if you want to stick with a professional advisor, nothing wrong with that. But now you have the information that you can educate yourself and even educate them, the so-called professional. If you want to know more, join my quantlabs.net / contact to get on my email. Okay, we'll send you out some info, and if you want to join, you join. You don't. That's up to you. But at the end of the day, if you want to continue to preserve your capital and grow it, moving into these challenged times, you know what you got to do. We'll leave it at that. Thanks for watching.